Hey everyone, Paul Clark here, and in this video I want to take you back in time to cover Facebook's IPO. And I don't think that this is just an academic matter, to go back and understand, the risks that were going on, what different analysts were saying about the company. I think that putting those in perspective to see what actually happened can be really meaningful. Because first of all, this was a company that was already generating millions of dollars in profit. I know a lot of IPOs, when they're at that stage, that they're not necessarily making a profit, so that certainly set Facebook apart. But when you look at it, Facebook came out of the gate priced at $38 a share, okay? And that was in May 2012. By August 2012, their share price had fallen down to $18. So their share price was cut in half by more than 50%. So again, think about that. If you were really high on the stock and you were thinking, hey, I'm going to put $10,000 into Facebook, I really think the long-term numbers here make sense for me, I want to buy and hold, you would have watched your $10,000 get cut to below $5,000 in a matter of months. And really, no matter who you are, I think when you're investing and you kind of run into a situation like that, it can be hard to stick with it, okay? But what would have happened if you would have stuck with it? Well, from the $38 at their IPO to where they are today, so they're currently closed at $276, that would have been over a 600% increase, okay? And that's huge, it's substantial. So what I did is I wanted to go back, look up some different news articles, look at what different analysts were saying about Facebook stock at the time of the IPO, shortly thereafter, to get a little bit more insight about what happened, about why the stock was falling, and again, about why a lot of people got that wrong. And there were certainly a number of people who got that right as well, but I think we can learn from both sides. And when you think about Facebook, by the way, I mean, they are a profitability powerhouse. They've been, at this point now, looking at their full year from 2016 to 2019, they earned over $10 billion in each of those years in net income. Over $10,000 million in net income 4 years in a row. And they've continued to grow that. And actually, most recently in 2019, it was closer to $20 billion in net income. Those are huge numbers. A lot of companies out there would be happy if those were their revenue figures, let alone their net income figures. Now, when you look at Facebook's business model, though, what makes them so profitable, I think this is interesting to keep in mind. I think one of the things that makes them so profitable is the fact that they have a lot of people generating content for them for free. Okay, so think about, news stations. Think about, Wall Street Journal or Fox News or CNBC. All of these people have to actually pay money to generate content trying to get you to their website. But for Facebook and what their business model is, they have, billions of users that are all too happy to log in and create the content of what's going on in their lives with their family and traveling and all of these things. And all of that stuff makes it watchable, makes it something that you want to engage with, okay? So the fact that they're getting all of that content generation for free, and then they're able to, leverage that by selling ads against that content, that's why this is such a high margin company, why they're so incredibly profitable. But with that in mind, again, I wanted to, at this point, kind of just walk through what some different analysts were saying, what some different news reports were back in 2012, and then I'm going to kind of take you on like a deeper dive, bring you over to Excel, and we can kind of walk through, what I think might have been a way to value their stock, value that IPO, and again, what we might be able to learn from that for the next go around. There was an article in the Wall Street Journal. This was the day before their IPO, and I really got a kick out of this one because General Motors came out and said, hey, we're not going to be advertising with Facebook anymore because we don't really see the potential. We don't really see that it's going to help us sell cars. So we're stopping our advertising with Facebook. And, again, I thought that was, really hilarious. I don't know what their actual ad spend is currently. I would be shocked if General Motors didn't actually go back to Facebook to leverage their ads there. But clearly, if not for General Motors, there have been a lot of other companies that have found use in investing into Facebook ads. So again, I just thought the fact that they didn't see that potential there, they weren't getting the ROI back in 2012, it's a little amusing to kind of reflect back on. Here's another good one. So there was an analyst with Morgan Stanley, again, back in 2012, that said that they were concerned that Facebook was showing a growing problem being able to make money off of their user base. So they're saying, hey, they're accumulating all these users. That's great. They're not making money with them. And why are they struggling to make money with them? Well, this analyst was arguing that they were not in a position to be able to make money off of their mobile platform. And again, they were not sure that they were ever going to be able to make money on their mobile platform. Well, let's flash forward to 2020. I think a lot of us have Facebook installed on our phones, and it's something that we, use on a mobile basis quite frequently. And we're becoming increasingly, more accustomed to seeing ads come across on mobile as well. So again, analysts at that point thinking, hey, mobile's a concern. Are they going to be able to figure this out? Well, BMO had concerns about user growth, and they had concerns about their advertising model. They weren't sure that they were able to actually, going to be able to connect to those advertisers, that they weren't going to be able to connect to those General Motors who were discontinuing their relationship with Facebook. And again, clearly not the case. On the positive note, so analysts with JP Morgan and Goldman Sachs, they came out really kind of gushing over this stock. They said, hey, they came out with a $45 price target on this, which again was the highest at the time. So they were the most bullish at the time. And their biggest, thesis there was to say that they thought that there was going to be just increasing access and use of the internet, and that Facebook was a pioneer there. They're already profitable, and they're going to continue to be able to grow and be able to monetize that user base. Okay. And I think all of those things, for as much as they were kind of over the top then, for as bullish as they were back in 2012, those things have come true and then some. Facebook absolutely has been a pioneer. They have led the way, and they've been incredibly successful in being able to monetize their user base. And one of my favorites in all of these, and the last one I'm going to cover before we kind of get into revaluing the IPO and kind of looking at some of the historical data from 2012 to 2020 here. The New York Times had an article that they put out where they said, when you look at Facebook and what their stock price has done, and they were really kind of looking at it from, okay, their IPO was $38. They've fallen over 50%, within the first couple months. And they were really kind of using that as a way to say, hey, this is proof that stock picking is dead, that, your average investor can't pick stocks that are going to, outperform the market, and they were just really kind of pointing all those things out. And, of course, that, obituary was written a little too early because, again, if you were an investor that believed in Facebook, you kind of were more on the JP Morgan, Goldman Sachs side of this investment, you did quite well from 2012 to 2020, okay? And, one of the interesting things about a company like Facebook, by the way, is that, there are a lot of companies that when they go public, it's a little esoteric about what the business model actually is. And, it's not always clear, what investors are really getting themselves into. But I think one of the really big differentiating factors with Facebook is that this was something that, at the time, a lot of people probably already were using this product. So they could understand that their friends and family were actually engaging positively with Facebook. Again, the fact that they were already profitable, which already set themselves way apart from your typical IPO. There were a lot of things to be excited about if you just thought about it from an actual user perspective. And then you couple that with some of the analysts who were more bullish, but kind of were ultimately correct, historically correct, then you had an opportunity to make a really good long-term investment. So all that being said, let's kind of go into the numbers and say, okay, what would this IPO have been priced at if we would have had access to some of the numbers today? Now, and I'm not saying it's just as easy enough to say that, the current stock price is $276. That's clearly where it should trade at. Again, I'm trying to say, okay, based on the 2012 to 2019 full year numbers, if we would have had that information back in 2012, what would have kind of been the fair value of the stock? Okay, so let's get into it. Okay, so here I've compiled a list of historical information for Facebook going back to 2011. This goes all the way out to 2019, and then I've kind of got some year-to-date information that I'm going to sum up from the 2012 to 2019 time horizon here. So just a quick overview. I've just got the revenue laid out. Again, these are actual results. Then there's the year-over-year change in revenue underneath that, net income by year, again, actually reported, and then what the actual year-over-year change is underneath here. And then this is what the number of shares outstanding were. And for each year, I just went through and I took the shares that were outstanding. So this is going to be the combination of the Class A and the Class B shares that were reported in the last quarterly report for that year. And then coming down here, I just simply divide the net income by the number of shares. Now, because I kind of took that shortcut, just grabbing them from the most recent quarterly report, some of these might be off by a couple pennies from what the company actually reported. But because I was kind of using this to really kind of say, what would we do if we were going to go back to 2012 and we were going to revalue this company, basically having the actual information, I think that still makes sense. Then I've also listed out just what the sales or what your revenue per share is here as well. And then when we get down to the free cash flow per share, this is for 2012 through 2019. This is actually what the company reported on a per share basis. So these are actual numbers. And, I wanted to be more exact here because this is what we're actually going to be discounting. So, I know that in a lot of discounted cash flow type analysis that people can do out there to value stocks, they, have some criticism with them. And part of the criticism, stems from, the uncertainty of being able to predict the cash flow, this many years out in the future. And certainly, if you go back to 2012, there was a lot of uncertainty with Facebook about, how they were going to be able to adapt to mobile, if they were actually going to stick as, the dominant, social networking site. Certainly you can think about, MySpace was something that people, I think, certainly were more aware of back in 2012, aware from the perspective of, hey, if they could fail, how solid is Facebook's business model? But even with those concerns, I think this should really kind of jump off the page. The fact that, this company, the fact that Facebook went public in May of 2012, and the year before they made $1 billion in net income. That's a huge number. There are a lot of companies that have been around for much, much longer than Facebook that would be, very envious of being able to say they put $1 billion to the bottom line. And I think that, when you look at a lot of IPOs, a lot of them are based on hype with the future. Like, hey, we're going to grow our user base, or this is all going to work out, and that's going to eventually lead to profitability, but right now we're not profitable. So again, that was never a concern with Facebook. So, just kind of wanted to point that out. And then, in fact, not only so did they have that success, but, at no point did they record a net loss on an annual basis after going public either, okay? Now, this is something that I think really bears calling out, and this was kind of, to be honest with you, kind of a learning point from me. I think that, if you were going to go back and think about revaluing, what the value of Facebook is per share, I would have been really tempted to start out with the number of shares they had in 2012. So they had this about 1.8 billion shares in 2012. And I would have been really tempted to kind of, do the figuring as far as like, revenue growth or what the sales multiple should be, or, different multiples, things of that nature. And then I think I ultimately would have wanted to come back after figuring out the market cap, and I would have wanted to divide by the 2012 shares that were outstanding. And as you can see, from 2012 to 2013, the outstanding number of shares jumped by 29%. And then, by 6%, 9%, and then it kind of leveled off. And then most recently, the company's actually been engaging in share buybacks. So I think this is something that, certainly with tech IPOs or with a lot of IPOs, that if you're going to be forecasting out, kind of per share information, I think it's definitely, wise to take into account the potential future dilutive effects. And that's not all bad. Again, I understand that, yes, they're diluting it, from 2012 to 2013 by 29%, but, a big chunk of that 29% increase is going to be from stock options to incentivize management of Facebook to continue to be successful. So you're giving up a little bit of the company, but you're doing it, in theory to, again, for the good of the cause, which, I mean, certainly when you look at the numbers, it worked out that way. Not saying that's what drove that, but I mean, certainly you can learn to live with that when you have the kind of growth that Facebook has shown. Okay, so all of that being said, if we just look at the free cash flow that they had per share, and if we look at this from 2012 to 2019, and let's just say for the fun of it, that was the only free cash flow that was going to be available to you as an investor. Okay, so let's just say, back at the IPO, let's just say, you were saying to yourself, what if I could only participate in this company's free cash flow and their earnings for the next 7 years or until 2019? Well, how much would Facebook have been worth if that was the case? Well, again, all we have to do is lay out the actual numbers for the free cash flow. And then underneath of it, I'm just going to go ahead and I'm discounting this back using the present value formula in Excel. So we say that up here equals PV. So I'm discounting that back and I'm doing it. And that's kind of why I have up here the periods that we're in. So, when we're in 2012, if we're participating in the IPO, we're not discounting that back, so we're going to set that to 0, but we're going to discount 2013 back 1 period and 2014 back 2 periods so we can see that's what's going on. And then if we sum up that amount, we come to find out that is $19.21, which is actually the amount that I've plugged in right here. Now, why is that little bit of exercise kind of interesting to call out? Well, if you remember, Facebook, their stock fell as low as $18, just a few months after their IPO in 2012. So they went public at about $38 a share. By August, they were cut in more than half. They're trading $18 a share. And the funny thing is that if you would have actually bought Facebook at $18 a share in 2012, you would have literally been able to, in the next 7 years, you would have literally been able to say, I'm fully going to get the fair valuation of that company, and literally everything else after that point would be, just 100% gravy. So that would certainly be an amazing position to be in. And instead, analysts were talking about how it was a bad stock pick, about how it wasn't going to work out, and mobile wasn't going to work out, and all the concerns. So again, there's the kind of the guessing about what was going to happen. There's the reality of what happened, and clearly, if you were able to pick this up at $18 a share, just from the valuation standpoint, you would have been very, successful in doing that. And you might be wondering, by the way, because we know right now. I mean, we can see what the share of Facebook is trading at, and we know it's well over $200. And so you might be saying to yourself, well, we know that we would have been able to recoup that, $18 within the first year or two anyway, just in terms of where the share price was trading at. What I want to remind you here is that what I'm trying to do is really kind of get back to like a true fundamental analysis of this, where I can say, regardless of where shares are trading at, what was the actual value you were getting? And I'm saying regardless, of what the stock was trading at, that you were getting the value of over $19, for just a 7-year period of performance when it was trading at 18, as if it was going to be existing forever. So, and I think that's, just to kind of go a little bit more in depth on that quick, what I mean by that is you could have a company that, if Facebook was trading at $18 in 2012, and it could have in the next year gone to $100 a share. And then at the same time, the valuation, or kind of the fundamentals from 2012 to 2019 could have, let's say, worked out where the actual discounted valuation would have been $30. Well, then you could say, okay, yeah, you got lucky from maybe, making some money from the share price. But when you, again, look at the value that you were getting from what the business was earning, that wasn't a good deal from that perspective. So trying to kind of make the distinction between those two different perspectives. Now, what if, by the way, you're thinking to yourself, because again, I know it's kind of interesting to me to think about if you were only going to actually get the value of this from 2012 to 2019, but in reality, you're probably thinking, hey, This is a company that in all likelihood is going to be around for a long time. So what would be the value of this company back in 2012 if you were going to just say, the full time horizon for this company? And so I did kind of a quick back of the envelope. And again, this would be assuming that if you would have had this information in 2012, what the next 7 years would have been like if you would have taken those 7 years and then built out an additional forecast that would look at what their projected free cash flow per share would be. Well, it looks a little something like this. And so what I was assuming was that, we would, from our $7.43 in 2019 of free cash flow, that we'd be increasing that by 10% all the way up until, 2030, and then we'd be increasing it by 5% until 2040, and then after that point, I'm just going to say that it's steadily going to decline. First it's going to decline by 2%, and then 10%, until it runs out of time, basically, right? And by that point, once you're discounting information over here, it becomes kind of irrelevant anyway when you get past, talking about the year 2132. So if we were going to, again, make the assumptions of, okay, free cash flow, the 10% growth, and then kind of go into the next decade, 5%, and then eventually kind of starting to actually decline a little bit, then if you were going to add up all of those discounted values at 9%, you would have said that, hey, back in 2012, you actually would have been able to say that this stock was worth $126, which still would have been conservative, of course, compared to where it's trading at today. But just wanted to kind of show one way that you would be able to kind of model that out if you would have had that information back in 2012. And then down here, I know I had mentioned this earlier. I think this is, again, it's a really important part to talk about here. Talking about, if you would have started out, let's say in 2012, you were feeling really good about Facebook and you're incredibly successful, and you say, I'm going to buy 10% of the shares that are outstanding. So you're going to buy 187 million shares of Facebook, which is going to allow you to be a 10% owner in the company or have a 10% stake in Facebook. Well, what percent stake? So if you didn't buy any shares, you did nothing else, you had your 10% of the company, what percent of the company would you have after your dilution? Which is to say, after they went from having the 1.8 billion shares, when they went back to 2019 or went ahead to 2019 and had the 2.8 billion, what would that have done to your ownership? That would have actually had you decline to 6.6%. Okay, so you would have gone backwards, just simply by them having more shares out there. Just something to keep in mind. And now I want to show you, so again, this is all information here for Facebook. Again, based on what actually happened 2012 to 2019, I thought it'd be a little fun to kind of go back and try to revalue this. Again, hopefully you guys get value out of that. So, we walked through kind of valuing Facebook stock, saying, what if we actually, had, the information from 2012 to 2019 actual results, and you were trying to value the stock, so we kind of walked through, some different ways to think about it from that perspective. But, clearly back in 2012, we didn't know the future. So I want to kind of walk you through, one type of modeling technique that you could have used to try to figure out what the future value of Facebook stock was going to be. So I would start out with this, I'm just plugging in, and I'm doing this valuation here just based on sales growth and the sales multiple, just because, certainly with a lot of, tech stocks, the focus is kind of like trying to grow the user base, grow sales, and then kind of figure out a way to monetize it. We already kind of talked about the fact that Facebook was way ahead of being able to monetize it, but still with that in mind, I just kind of wanted to do like a sales focus on this. You could certainly do a similar thing, modeling out earnings or free cash flow, whatever else other metric you'd like to think about. And then ideally, you would actually do it with multiple metrics, and then you can kind of average them all. So like, let's say one methodology says, or the sales multiple says that, the value is 80, but, the free cash flow you're modeling out says the value is 70. Maybe you take the average of that and say, hey, I think it's actually about $75 for the fair value. That would certainly be one approach. But I started out here just taking the 2011 revenue. So this is linked to our financial data that we already covered earlier. And what I have done here is then kind of laid out, what their potential sales growth could be in 2019. So what their sales could, turn into, in terms of, a multiple. So this first one, if we looked at, well, what if their sales grew by 3 times? So, being in 2011, 3.7 billion. If they grew 3 times in 2019, their sales would be a little over $11 billion. And then for each of these, I've just assigned a probability. So I'm going to say, okay, well, what if you thought there was a 2.5% chance that they grew by 3 times in 2019? So basically trying to say, hey, the most likely scenario in our kind of model here is that they're going to grow to 10 times the size by 2019. And I'm going to assign a 35% probability to that. But again, at least this one kind of captures the probability that, hey, they might not be as successful as what we're thinking. Or on the flip side, what if they're, a lot more successful than what we're thinking? And then, all we have to do is that, we would multiply the probability times that value projected at that multiple there, or that sales growth, and that would ultimately give us a number that we'd be able to add back. And adding all of those up would give us an expected growth by 2019, or expected sales for 2019. So in this particular case, we would actually be saying that we would expect sales to be a little over $38 billion. And I say a little over, talking about, 100 million, like it's pretty insignificant. So sometimes it can be good to keep that in perspective. It's still a lot of money, of course. And then, on the flip side, you can say, hey, that's great. If you're trying to model what the actual sales are going to be in 2019, you can say that's great again, but what is the market going to assign on that in terms of a multiple? Are they going to be trading at 2 times sales, 10 times sales, 5 times sales? What does that look like? Well, here I'm going to say that the most likely scenario is trading at 8 times sales in 2019. I'm going to say there's about a 30% chance. And then we can kind of see that probability distribution here. Now, the nice thing is the way I have this currently set up is if you actually wanted to tweak any of these things. So like, let's say, you were thinking that there wasn't a 35% chance of, this, 10 times sales growth here. If you actually thought that there was a 50% chance, then you could just, adjust this accordingly. So right now we'd have 115%. So we'd have to take this down. What would that be? Is that right? That is not right. If we do it correctly, though, it will be. Okay, so if we were going to adjust these percentages down over here and say that that's going to be 50%, then we can kind of see how that impacts things. Again, that's not going to have a huge impact here. But what if we thought the 50% distribution was actually going to be, at 15 times, and then this was going to be the 2.5%? Well, clearly that did really move the needle significantly. So we can kind of just, play around with the different sales growth, and likewise, we can play around with the different probability distributions for the sales multiple. So ultimately now I'm saying, okay, based on, these projections or probabilities, we're going to say 2019 revenue is going to be at 38.1 billion. The sales multiple, so the market's going to say, hey, we're going to pay a little over 8 times revenue for that. And then that's going to leave a market cap, so just multiplying the two, of 313 billion, or a little under 313 billion. We can see that here. Now, if we just divided that market cap per share, we would come up with 166.52. And then if we discounted that back to 2012 dollars, we'd find that the share price would be fairly valued at about $91. However, what that wouldn't be taking into account would be the dilution. So here I'm basically saying, hey, let's figure out, how many more shares, were out in the market, compared to 2012, how much that dilution factor was, and then multiply that by that 9109. And then that gives us a value here that says, okay, we would, based on this model, we would have said, we would think that Facebook in 2012 at the time of their IPO would have been worth about $60 a share. Now, there's still a lot of unknowns, and I think we're even kind of, the fact that we, know what that dilution was, that certainly helps to be able to kind of get back to that $60 kind of price target here. But that being said, even though we're never going to be 100%, what dilution is going to be, when we're kind of looking forward in some of these things, but I think at least knowing to take that into account, is something that could, be useful for you when you're actually looking at valuing some of these IPOs per share. Okay, so that concludes kind of a recap of the financial information here for Facebook. Like I said, I think that, to me, this is not just an academic exercise. I think that this is really valuable to kind of, pull some new learnings to light here. Again, even for myself to really, contemplate, taking into account dilution when you're forecasting, the growth of some of these IPOs. I think that's an important takeaway. I think that understanding how we can model things when we don't know the information, how we can, keep ourselves focused on, actual fundamental data when we're kind of figuring out what value, ultimately was delivered on a per share basis. So hope you guys enjoyed this video. As always, any questions or comments, go ahead and let me know in the comment section, and thanks for watching.